Imagine trying to understand a complex financial product that combines elements of stocks, bonds, and derivatives. It's not easy, right? That's where Token Engine's Structured Product Evaluator comes in. This AI-powered tool simplifies the process by analyzing term sheets of structured products like equity-linked notes or auto-callables and provides clear, actionable insights into their potential risks and returns. Whether you're an investor, financial advisor, or portfolio manager, this tool can help you make informed decisions without needing to be an expert in advanced finance. Now, let's walk through some highlights of this evaluation report for a Morgan Stanley equity-linked note tied to the Stocks Europe 600 index. The report is packed with useful data, but we'll focus on the most interesting sections. First, take a look at the executive summary. Based on 10,000 simulations, the structured product offers an expected annualized return of 6.66%, which is significantly higher than the underlying index's return of 3.6%. At the same time, it has lower volatility, just 10.99%, compared to the index's 15.7%. What stands out here is the downside protection. While there's a slightly higher chance of negative returns, 48.49% versus 42.25%, your maximum loss is capped at 5% of your initial investment. And if things go really wrong, the 99% value at risk shows you're only exposed to a potential loss of 1.45%, far better than the underlying index's negative 30.86%. Next, let's talk about the product mechanics. This is a principal protected note, meaning even in the worst case scenario, you'll get back at least 95% of your initial investment. On the upside, you participate in 110% of the index's gains, giving you amplified returns if the market performs well. However, there's a catch. If the index drops, you'll absorb losses up to 5%. This structure makes it appealing for conservative investors who want growth potential, but also value capital preservation. Moving to the simulation results, one particularly interesting chart compares the final returns of the structured product against the underlying index. You'll notice how the product smooths out extreme outcomes, big losses are cushioned, and large gains are still achievable, albeit within limits. Another standout feature is the risk-return profile graph. Here, you can see that the structured product sits favorably compared to both the index and the risk-free rate, offering a better trade-off between risk and reward. Let's dive into the detailed statistics section. One key metric is skewness, which measures the asymmetry of returns. For the structured product, the skewness is positive at 0.85, indicating a higher likelihood of extreme positive returns. Compare that to the underlying index's negative skewness of negative 0.12, which suggests more frequent small losses. Additionally, the minimum and maximum returns tell a compelling story. While the index could lose up to 57.72%, the structured product caps your loss at 5%. On the flip side, the product's maximum return of 142.56% shows its ability to deliver substantial upside. Finally, the investment commentary provides valuable context. Among the strengths, the 5% downside protection is a major selling point, especially in volatile markets. The enhanced upside participation rate of 110% further sweetens the deal. However, it's worth noting the considerations too. For example, the product has a slightly higher probability of negative returns due to the 5% floor. In conclusion, Token Engine's Structured Product Evaluator transforms complex financial instruments into digestible insights. By breaking down the numbers and visualizing scenarios, it empowers investors to weigh the pros and cons of these products confidently. Whether you're looking for downside protection, enhanced upside, or simply clarity, this tool bridges the gap between complexity and understanding.